Hello, everyone. Today on the final bar, I'm joined by Dana Lyons from J Lyons Fund Management and the Lions Share Report. We'll talk about the overall market environment, the S&P choppy day today after yesterday's distribution, the distribution through the course of the last couple weeks. Today, sort of chopping around, finishing in a position of relative weakness, but not far off of yesterday's close. We're going to talk about the defensive leadership today with utilities, consumer staples at the top of the list, but let's keep a proper perspective. What does the big picture look like? Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the chief market strategist here at StockCharts.com in a rainy Redmond, Washington. Thanks for joining us every weekday after the close as we focus on the markets through the perspective of momentum investing, analyzing the indications of price, breadth, sentiment, trend, and momentum. A little later in today's show, we're going to break down some of the breadth indicators. We have a segment called Banking on Breadth that we like to bring in every week or so just to look at some of the breadth conditions. And we've talked about breadth deterioration and really how the character of the market really changed, right? The first quarter into the second quarter, then the second quarter into the third quarter. Very different market environments in terms of leadership, cyclical leadership to growth leadership. And all of a sudden, in the last couple of weeks, we've seen potentially another change of character here with things like the NASDAQ 100 testing support and arguably failing its support. The dollar index actually breaking to new swing highs, which we'll look at a little later in the market recap, and just the leadership picture, right? Rising rate environment. Where do we see opportunities there? Is it a return to the strength of the cyclical sectors? We'll try to tease out all of those themes as much as we can in our short time together. We have some great guests on the show. I'm excited to talk to Dana Lyons here in a few moments. Always does a great job of helping us think about the big picture appropriately. Tomorrow, one of my mentors, Jeff Weiss. Jeff is the technical analyst at Clearview Trading Advisors in New York. He was at Jessup and Lamont for a number of years. That's where I first met him in the early 2000s, and I learned a great deal from him in terms of being patient and focusing on the long-term trends. Next week on Tuesday, we have Craig Johnson from Piper Sandler. And then very excited to tell you next Thursday and Friday, I will be out on vacation. That's what I'm most excited about. We'll be heading to Oregon and getting out of things for a little bit. But I'm also excited that this show will be in very capable hands. On Thursday, the 7th, Julius Kempner will be hosting the show for us. On Friday, the 8th, Tom Bowley. Both of them very, very capable, and should be a lot of fun to have them on the show for sure. Also, we recorded The Pitch yesterday. It was a lot of fun. It was featuring Tom Bowley, also John Kosar from Asbury Research, and Joe Rabel from Rabel Stock Research. We had a great discussion about just how to think of this environment. We recorded it as the market was dropping. It was a really good discussion. Go to stockcharts.com/the pitch if you missed that fantastic event. Let's continue on with today's market recap. So what we'll talk about is the overall the conditions today really choppy, right? And we've had this sort of push and pull between distribution days and sort of choppy digestion days. And think of yesterday as the big meal where you drop down, you take the big plunge, and then today is more of a choppy. Really, midday yesterday through today is sort of a choppy sideways pattern where you're sort of range bound between 43.50 and 43.80. The S&P closing down toward the lows of that range around 43.60. That's just a hair above where it started. The Nasdaq and the Nasdaq Composite down a little bit from yesterday. Mid caps flat, small caps up. So small caps continue to lead things on the upside, both in up and down tapes, which is actually interesting to see. Quickly on other asset classes, interest rates coming up by the end of the day, although weaker earlier in the day. So bonds sort of rallied out of the open and then came off with the 10-year yield around 154. Again, pretty elevated from the lows we saw not too long ago. We're in the 111, 120 region, and now we're back up above 150 again. The dollar index is quite an interesting chart, which we'll look at here in a moment. The UUP breaking out of a congestion range, basically breaking to new swing highs. We'll look at that and what that means. What are the implications for a stronger dollar environment? It's a little different than the environment we've been thinking about. Gold and precious metals weaker here. So if you think of gold as a safe haven, it should be ripping to the upside. not the case. And I think that's the danger of one of those narratives. Gold is a safe haven. The real answer is kind of. It's kind of a safe haven some of the times. That's not a great relationship I would want to bet my capital on. I would focus much more on the charts. The charts very much, I would think, without argument, in distribution mode, but I'm maybe biased on that one. Cryptocurrencies bounced higher. We had a really good discussion yesterday with Alessio Rutiliano. He's a cryptocurrency expert at Wyckoff Analytics. I did a great job talking about some of those markets and how to think about cryptocurrencies over the long term and what the short term means relative to that. But bouncing higher after some serious distribution recently, and should note in the last 12 hours, certainly rotating down to the downside. We'll come back to the sector themes here. I just want to touch on a couple of the macro charts here. We'll try to get through the S&P, look at the dollar, look at gold as well. So the S&P 500, I think, still sort of in that testing mode, testing support. The red sort of bold-faced line that I have on my chart is the line in the sand, in my opinion. Now, someone asked on social media, is that a long-term reversal? And no, I don't think you can make long-term decisions based on short-term data. If you want to make long-term decisions, look at the weekly chart of the S&P. That will tell you more of what you need to know in terms of the long-term trajectory. And the long-term trend in stocks still remains fairly robust. What does this mean for the short term? If you consider this a head and shoulders top, and while the S&P, you're arguably getting a breakdown this week, I think the NASDAQ 100 maybe a clearer breakdown this week in terms of breaking the neckline, connecting those interim lows. But remember that the way that a head and shoulders pattern kind of works is this. You have a head, a high, surrounded by two shoulders, two lower highs. You take the neckline as sort of that interim low. So, technically it should be down here if you want to be a stickler for the intraday lows that you should be using. But whatever you decide is the neckline, once you break that, you take the height of that pattern and you subtract it from the breakdown, which means if this is a head and shoulders pattern and you're going from 45.50 down to 43.50, then the very simple math or simple visual analysis takes you down another 200 points or so. And the downside objective, given the height of that pattern, would take us down to around 41.50. What's interesting about that as a downside target is that's right about where the 200-day moving average is, and that's about where it's going to be for the foreseeable future. If you would look at the percent changes, we can do that here. If we would go down to 41.50, that takes us, say, about 9%. That's about right? 9 or 10% down to the 200-day moving average. That would take us just below the June lows, back in the range of the May lows, which would be a pretty decent pullback. So, from the all-time high that we saw at the beginning of September down to the 40.50, which would be a 38.2% correction, up to 41.50, that's about a 9 to 11% drawdown from intraday high. Still not bad in terms of the long-term context, and I think I would keep that in mind. We've been talking a lot about the short-term distribution patterns and breaking some of the support levels. When we were talking on the pitch yesterday and talking about some of the long-term trends, remember that the long-term trends overall very encouraging, and I would not be surprised if we see renewed strength going into year end and beyond. It's all about this navigating the short-term period where I think there could be some further dislocation for sure. I mentioned the dollar index. The dollar bounced higher about 0.7% on the UUP. The dollar index chart looking very, very similar to this. The levels are a little bit different, but what's interesting about the dollar index is actually making a new swing high, making a new high for 2021 and breaking above a previous resistance level. The UUP had hit resistance from late March, hit that again in August, bounced up to it again this week, and now following through to the upside. And so, we've been in a transition phase from a weaker dollar through much of 2020 to a stable dollar, is I guess how I would describe it, sort of, sideways through the course of much of 2021. But the last couple months have actually been overall a short-term uptrend, and now you're breaking above that swing high. And so, when you think about that rotation in the dollar, just I would think of that in terms of a macro tailwind or macro headwind, right? We're transitioning from a period where the dollar is weaker and then a dollar sideways and now a dollar stronger. The euro chart, by the way, if you look at this, essentially this flipped upside down and a bit of a distribution top breaking down through key support. So what does that mean for U.S. stocks versus non-U.S. stocks? What does that mean for small cap stocks versus large cap stocks? Those are the things I would be thinking about in terms of the implication of the dollar and what that might mean on the big picture. Now, the good thing about charting is the answer should be reflected on the chart. So thinking about the dollar and whether it's a headwind or a tailwind is one part of it. I think looking at the charts of the assets, of the stocks, the ETFs that you're focused on is the most important thing that you can do. We talked about gold briefly, and again, gold certainly feeling further pain today, pushing down. We're now testing the swing lows for the last 6 months or so. We're testing the August low this week, and below that you have the March and low into early April. It's around 157, 157.50 on the GLD. So we're close to breaking down through the previous support. I think there's a lot of support to be expected right about here. This is the low for the range over the last year or so. Breaking below that would certainly be an indication of a further downside potential, breaking that final level of support that's held for quite a while. But my point of bringing this up is that the down move that you saw today in gold, while the movements on one individual day can always be a surprise, gaps can be a surprise. The trend in gold has been down for quite a while, and I think its failure at around 171, 172 here in early September was unable to get above the July and August highs was the most damning part of that chart. Sectors today, by the way, just to finish up our market recap, a little more on defensive mode with utilities, consumer staples, even healthcare and REITs. Those are the four top sectors. On the downside, you have some of the groups that have been doing a little better, things like materials and energy, but you also have technology and communication services. It's interesting, not too long ago, tech was sort of the bellwether, sort of did well in every market, right? It led on the up days, led on the down days, and you had this period where technology's relative strength was just consistently strong. We are not in that environment right now, with technology coming off with the other growth sectors, given higher rates, which is certainly a bit of a headwind for the performance, some of those growthy sectors. We need to take a quick commercial break. We'll be back with my guest, Dana Lyons. We'll see you in a minute.
What if you could look beyond price and identify big moves in the market before they happen? That's why we created the Moxie Indicator Minutes. Hosted by me, T.G. Watkins of Simpler Trading, the creator of the Moxie Indicator. Each week, I'll provide you details about the indicator, what it does, and how it can work for you. Only on StockCharts TV.
Hey everyone, welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. It's great to have you join us every weekday after the close as we break down the charts together, try to navigate these uncertain times using the power of technical analysis, the power of StockCharts.com. As a reminder, we love to hear from you. Yesterday, we had a lot of fun going through your mailbag questions. More to come at the end of this week, and we would love to answer your question on the air. Anything about technical analysis, particular charts, ETFs, tickers that you're breaking through, ratios, whatever it is, we're here to help point you in the right direction. Our email is thefinalbar@stockcharts.com. That's the best way to get a hold of us. We're also on Twitter @FinalBarSCTV. We're on YouTube. Put a comment below the video you're watching on our Stock Charts channel. We would love to hear your questions. Hope to answer one of yours in our mailbag segment on Friday's show. Also, as a reminder, go to StockChartsTV.com. Use your email address. You can set up a free account, start watching all of our great content from your mobile devices and from our website. Great shows like The Final Bar and others, Stock Charts in Focus, where Grayson Rose does a great job of breaking down the toolkit of the technical analyst, special events like The Pitch and our year-end review. All of that and more on our on-demand platform, StockChartsTV.com, or search on any of the mobile device app stores, Stock Charts TV on demand. I want to welcome on today's guest, Dana Lyons. Dana's the fund manager at J. Lyons Fund Management, and also the editor of the Lyons Share Report. Dana, it's good to have you back on the show. You always do a great job of helping us think a little longer term. I feel like we all need a dose of that this week.
Yeah, thanks for having me back on, Dave. It's always good to be on.
So you're starting us with one of the ratios that I think is it's a beautiful illustration of sort of risk on versus risk off and where investors are making their bets. Talk us through this first chart.
Sure. From like a bigger picture perspective, we're in a little corrective phase right now, a short-term corrective phase, as you mentioned, and our quantitative models are on a sell signal right now. But it's helpful to look at kind of the big picture, foundational things from a technical internal basis, and try to determine, okay, are we on the verge of a major top, a serious bear market, or is this, just run-of-the-mill kind of a correction? And most of our research, most of the data that we look at would suggest that it's just, run-of-the-mill short-term correction and should be building up to a pretty good buying opportunity. And one example of that would be, so this risk ratio, the ratio between consumer discretionary versus consumer staples, which is basically a determination of risk on or risk off. Okay, so when discretionary is outperforming staples, usually that's positive for the general market. And despite the recent corrective action over the last month or so, this the ratio has continued upward. In fact, it's hitting new highs since the inception of these ETFs back in 2006, 2007. So that suggests to us that while there is some digestion, some corrective action that might continue in the very near term, underlying is a very strong foundational, internal, and technical market that's probably due for or on tap for another extension of the bull market, another new high in the bull market. So that's encouraging.
And I should point out, right, your chart's going all the way back to 2007. This is really looking at the long-term trajectory, the secular bull market in stocks, and how the ratio has certainly been driving higher recently. It's a great illustration of it. Your second chart. So let's look outside the U.S. We talked about the dollar chart a little earlier. You're highlighting Japan here. What is this telling you?
Sure. Well, going back to the first chart, if we're in a positive market regime, if we do think we're building up to a pretty good buying opportunity, another leg higher in the overall bull market, then we go to, okay, what sort of things do we want to buy? What sort of things might lead in the next leg higher? So we like charts like this, areas of the market that have held up pretty well during this correction or mini correction, have been resilient here. One such example that's kind of off the radar for many people is Japan, and specifically here, the small cap Japan market. So we see going back to the highs in 2018, which were the previous all-time highs in the Japanese small cap market. We see what technicians would call pretty much a textbook cup and handle. Made a similar high earlier this year after a brief correction for about 4, 5, 6 months. Came back up, tested, actually broke out to new all-time highs just in the last few weeks, pulling back now. This is when we're looking for entry points, this is about as good as it gets from our perspective after testing long-term highs for a while. You get a breakout, come back, test that breakout level, or which is what we call the launch level, where it started that breakout move from. And that's a perfect spot to get in. And we think things like this, there are plenty of charts like this. This might be the cleanest one that we see, but these are the types of markets, types of charts that are poised to lead higher and lead from a relative strength perspective in the next bull market up leg.
Your cup and handle watermark in the back of the chart is not lost on me. I think that's masterfully done, Dana. I love it very much. We have time for just one question. I'd love to,
Sure.
you talked about how, your models are showing that this certainly seems or appears to be a short-term pullback, that the long-term trend is still positive. And I totally see the idea there. That makes sense. What would you see, or what would you have to see to tell you to start getting more defensive, to start telling you this actually isn't a short, this isn't a buying opportunity, it actually looks like it's going to get worse? Is it a question of the severity of the pullback, or is it things like the ratio, the consumer ratio you showed us, starting to turn lower, showing that people are more risk off? What would you be looking for now to start to get more defensive?
Well, sure. So among the areas that had us concerned a couple months ago were some of the breadth divergences at the recent highs, combined with complacent sentiment, investor sentiment, as well as we're right in the midst of the most bearish seasonal period of the year for stocks. So those are three worries. The best, probably the best way of identifying the end of corrections, though, is through measures of sentiment. So what we wanted to see, what we want to see, and I would have brought charts on today if I was seeing it, were better indications of elevated fear levels among investors. So we've seen over the last couple of weeks some of that investor complacency dissipate. We've seen kind of middle of the road type of sentiment readings as opposed to overly bullish, overly complacent. We haven't seen those real spikes in investor fear that often mark the ends of these corrections. So I would be on the lookout for those types of things in terms of put to call ratios, the amount of activity in bearish ETFs and various other types of hedges. So but overall, just more of a spike in investor fear would give us greater confidence that we're near the end of this correction.
Dana, listen, always appreciate you very much coming on the show. Appreciate you bringing a couple great charts with you. Be well, stay safe. We'll talk to you again soon.
Sounds good. Thanks, Dave.
That's Dana Lyon. Dana's the fund manager at J Lyons Fund Management, based in the Chicago area. Also, an editor of the Lyons Share Report. And I love that first chart. When you think of the ratios, we tend to look at that ratio. We've talked about that ratio before. We tend to look at it on a much more shorter term basis. Talking with people like Dana reminds me to make sure that you're properly focused on the long term trends. Think about where we're at within the overall cycle and look at the trajectory that we've been on. And so when you see some of the short-term dislocations, some of the indigestion maybe that we've had, let's make sure we have the proper perspective. Think about the longer-term trends. Great couple charts and great thoughts from Dana Lyons. Let's continue on today's show. Our next segment is called Banking on Breadth. What we love to do with some regularity is look at the breadth conditions out there. Now, as we've talked about, market breadth for me is one of the three pieces of thinking about the macro environment effectively. It starts with price, and that is by far the most important. Second to that is breadth. And breadth for me means participation. You know what the indexes are doing, the S&P, the NASDAQ, the Russell. What are the stocks that comprise those indexes? What are those doing? And when you see some disagreements, especially, that's when it can tell you start to be concerned, and also can tell you, I think, ideally, when the conditions are evolving, when there's a change of character, a change in the character of the market. We're using our breadth indicator chart list as a reminder. This is part of the chart pack of all of the charts. Most of the charts, if not all of them that I show on this show, are all accessible to you. If you're a StockCharts member, go to your dashboard, go to your chart list. At the very bottom of your chart list, you have a gray button that says Manage Chart Packs. Mine is called Dave Keller's Morning Coffee Routine or something kind of like that. And this breadth indicator list, along with many others, is included in that free chart pack. First, we'll start about the S&P breadth by captors. This is using the cumulative advanced decline lines, and it's doing it on 4 different buckets of stocks. We have the New York Stock Exchange, the S&P, mid caps, so large caps, then mid caps, and then small caps. We don't have to go too much into detail, but when Dana Lyons had mentioned about the breadth deterioration, this is one of the charts that comes to mind. Another one we'll talk about in a moment with percent above their moving averages maybe comes to mind even more. But overall, I think you've seen this change of character, right? The market looked a certain way for the first 2/3 of this chart, really going through May into June. You see the market making higher highs fairly consistently. You see these advanced decline lines making new highs fairly consistently. Most of these advanced decline lines, all but one of them, made their last all-time high in June. From there, they've actually made equal highs or lower highs. And so the New York Stock Exchange breadth has actually been sloping downwards. It's below its 50-day moving average. Same with the small cap advanced decline lines, rotated from a bull phase to a bear phase. The S&P, the large cap AD line, has actually been trending higher, just recently breaking down through its 50-day moving average earlier in the month of September. So all of these have rotated from a bullish phase into June into more of a bearish phase, or at the very least, not confirming the new all-time highs that we've seen in the S&P 500. That's pretty classic for the end of a bull market phase. I actually recorded a video for my YouTube channel called Market Misbehavior, looking at the 2021 conditions versus the 2020 top, the 2007 top, and the 2000 top. I'd encourage you to check that out. It's the Market Misbehavior channel on YouTube. And you can see more details about what I mean there. Next breadth chart we're going to look at is this one. This is actually one that's a favorite of Walter Deemer. Walter ran the technical research department at Putnam Investments in Boston in the 1970s, 1980s. He was one of the really founders of the technical analysis community and helped link the Boston community to the New York community, which became the CMT Association. That's your brief history lesson on institutional technical analysis in the U.S. in the late 20th century. But this is one of his favorite indicators, thinking about breadth, which is looking at the daily advanced decline volume, daily advanced or decliners, but using volume, not just using the percent changes. And one of the things you can look for are 90% up days, 90% down days, and basically what percent of the volume is on up days or up stocks versus down stocks in a given time. What's interesting is you actually had like an 85% up day about a week ago. This was when we had the bounce off of the swing lows where the S&P just narrowly touched 4,300. But from there, we've seen the slope downwards. So you've actually seen less and less volume on the up days. And this was yesterday, it was about 78% down day, right? Where 2/3 plus almost 4 out of 5 percent or 80% of the volume was on down stocks versus up stocks. And so certainly showing more signs of distribution. We had a 90% down day here. This was when we first closed below the 200-day, or excuse me, the 50-day moving average on the S&P. This chart we've talked about fairly regularly, and I think it's a beautiful one to illustrate that change of character. When we talk about breadth deterioration, I think this is a great way of demonstrating it. In mid-April, 95% of the S&P members above their 200-day moving average. Right now, it's just below 70%. In April, you had 92% of the S&P above their 50-day. Now it's about 33%. So 60% of the S&P had been above its 50-day, and it's now below it, just like the S&P has made that transition. But many stocks have done it well before this month, right? They've been doing it back here in April, May, and June. So you've seen this steady decline where a lot of individual names are rotating lower. What's happened is enough big stocks have done well enough to keep the indexes elevated, which is what's kept the S&P making new highs, kept the NASDAQ making new highs. But underneath the hood, you have a lot of individual stocks that are rotating lower. And it's interesting when you look at the chart of Activision or EA or one of those or anything in consumer staples, for example, you see a lot of pretty consistent downtrends. Biotech names breaking down and in pretty good downtrends, breaking their moving averages. This is in an environment where the S&P is actually making new highs. So we've talked about a stealth correction. The question is how that stealth correction ends. Do you get enough of a rally to push things higher? What my guest Dana Lyons was suggesting, implying, which I don't disagree with, is that this is a short-term pullback to sort of digest the distributions that we've had, to sort of reset things before we rally in, and showed renewed strength in stocks. And again, the beauty of technical analysis, the charts will tell you if that's what's playing out. It will be evident as the price stops going down and starts going higher. That's our segment, Banking on Breadth, focusing on some of the breadth indicators. A lot to talk about. We touched on a couple of those. I'd encourage you, by the way, to look at the McClellan Oscillator and the McClellan Summation Index, also showing some deterioration. We need to wrap today's show and go to the 3 and 3, 3 charts in 3 minutes. Here we go. Chart number 1 is the dollar index, $USD. My guest, Dana Lyons, was talking on the small cap Japan ETF, that cup and handle pattern. It's where you have a rounded bottoming pattern. So you have a peak, you sort of rotate lower, you have a gradual rise back to the previous peak, and then a shallower pullback and you break above the peak. Arguably on the dollar ETF, we're seeing that same cup and handle pattern, seeing this in a number of different charts, and that indicates some momentum building underneath this basing pattern. And when you finally break out to new swing highs and break above that resistance level, again, this is a 6-month base that it's breaking out of. Overall, seems to be a pretty positive sign. I think stronger dollars in the cards, and the UUP certainly is a good way to indicate it. What's interesting on this chart is in early September, the last time you pulled back, the RSI remained above 60. A lot of times that's what differentiates a bear market phase from a bull market phase. So interesting, it's made that rotation as well. Chart number 2 is the consumer discretionary versus consumer staples ratio. I thought Dana did a great job earlier talking about that equal weighted version, which is the bottom half of this chart. When you take the overweight of Amazon, Home Depot, and Tesla out of the numerator, and you just look at the denominator, you see that's breaking out as well. So it's not just the mega cap, the Teslas that are rotating higher. It's a lot of things within consumer discretionary. It's just on average, those names are doing better than consumer staples. That tells you that particularly larger investors are sticking with risk on right now, even with the market coming off. So that is an important risk on indicator that is not rotated lower just yet. Finally, I think it's worth noting some of the video game stocks bouncing pretty well today. EA, Activision, Take-Two are all popping higher today on a day when the S&P is flat. I think it's important to keep a proper perspective here. I think it's a similar thing that I see from airlines, right? In a position of weakness, and then you have these nice huge bounces, and it can be tempting to chase them. For me, one day does not make a trend. It's a series of days that you string together. It's looking at the longer term picture. If you look at the longer term trend for the last 6 to 9 months, Take-Two has been in a downtrend. It's made a consistent pattern of lower lows and lower highs. When it's tried to regain the previous highs, it's failed to do so, particularly in May and June. And now we've had a consistent pattern of lower highs and lower lows. As we keep making lower highs, as we remain above the 50 or below the 50-day moving average, I think charts like that, you want to wait until you see signs of accumulation. Folks, that's our show for today. Special thank you to Dana Lyons. And from all of us at StockCharts.com, I'm Dave Keller. Have a good night. See ya.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.